Aman, Raina here from Sage Investors, here to do a quick mind map analysis of pharmaceutical ETFs. One of the one of my core investing themes that I like to have, or exposure that I like to have in my portfolios, is on the healthcare side. And from what I've been reading recently, it seems like the pharmaceutical side, or the drug side of healthcare, of the healthcare sector, has been kind of underperforming the market. So got me to thinking, you know what, I think I'd like to get some exposure to that side of the marketplace. The thing is, right now I just don't have any time to figure out and analyze all these individual companies, and also one of the kind of risks associated with pharmaceutical stocks is they're exposed to a lot of volatility in terms of the lifetime of the drugs that get in their pipeline. Just it's almost like a lottery ticket for some of these drugs to get approved after they go through the whole regulatory approval process. So I don't really feel like guessing which or doing a deep dive into a lot of companies. I thought for me the easiest way to get exposure to the sector is just buying a basket of well diversified pharmaceutical companies and do it through an ETF. So I did a quick scan of the marketplace, and there are three ETFs that jumped out at me that seem to be worthy of consideration. There's the Van Eck Pharmaceutical ETF, ticker symbol PPH. There's the Spyder ETF group has a pharma ETF called ticker symbol XPH, and Ishares has a product ticker symbol IHE. So for each of these companies, normally what I do when I'm looking at ETFs is I try to apply some criteria and compare those criteria amongst a bunch of different ETFs, and hopefully at the end of the exercise I get a pretty good idea of which kind of ETF I want to add to my portfolio. So what I'm going to do here is just essentially walk you through my what I came up with as I was looking at these three specific ETFs. So the first one I'm going to look at, I'm going to start looking at the Van Eck ETF. First criteria I'm going to look at in terms of ETF is whether it's actively managed or passively managed. Is it being just following a traditional third-party index, or is it being managed by a bunch of people who are actually doing the analysis and picking stocks? So the Van Eck is an actively managed portfolio. They have about 25 stocks, 25 stocks in the portfolio. When I looked at them, they have their costs in terms of their fees. They charge an MER of 0.4%. In terms of liquidity, when I look at liquidity, what's the average trading volume of the shares? Does it trade a lot, or does it trade a little bit? Because that's important, because that can impact the type of prices you're going to get and the volatility price swings of the ETF. So in the case of the Van Eck, they trade on average about 45,000 shares a day, and which is okay, which is pretty decent. There's a bit of liquidity behind the fund. In terms of an index, what are they tracking? What are they benchmarking themselves to? As I said, because it's an actively managed ETF, it's essentially just it's self-indexed. It's created its own in-house kind of index, pharmaceutical index, and it benchmarks to that. So it follows a self-indexing benchmarking. And for those of you who followed me before, I'm not a fan of the self-indexing because it allows companies to kind of move the goalposts, and so kind of alter their performance by not necessarily altering kind of bad or mediocre performance by just changing the goalpost in terms of the benchmark that they're measuring themselves against. And so whenever I see portfolios or ETFs that are kind of self-indexing, it gives me a little bit of pause there from that side of it. I took a look at the tracking area in terms of the variance between its performance, its return, and the index that it's tracking, or it's trying to track. And their tracking error comes in at about 0.4%. 0.41%. So there's a 0.41% difference between the returns that the Van Eck earns versus the index that they're benchmarking themselves, which is pretty good. It's pretty decent. Pretty decent. So that's the Van Eck ETFs. Now let's take a look at the Spyder. Let's take a look at the Spyder ETF. Just get some stuff set up here. There we go. Spyder ETF, unlike the Van Eck, is a passively managed portfolio. So it's tracking a third-party broad market index. And in the case of the Spyder, it is tracking an S&P Pharmaceutical ETF. Fees and costs come in at about 0.36%, so it's almost comparable with the Van Eck. Liquidity, it trades on average about 37,000 shares a day, so it's fairly liquid for a specialty kind of fund. As I said, tracks the S&P Pharmaceutical Index. The portfolio makeup, it's a U.S. oriented portfolio, and it's fairly even, has a fairly even distribution. Like in terms of, there's no stock within the ETF that's greater than 4%. 4% seems to be the max. So it's a very even weighted portfolio, so you get a good diversification in terms of the assets within it. The tracking error for the XPS is pretty low. It comes in at 0.08%, so it tracks very, very closely with the S&P Pharmaceutical Index. So that's the Spyder. And so now the third ETF that I'm going to take a look at is the Ishares product, which is ticker symbol IHE. It is also a passively managed portfolio. Tracks a broad market index, specifically the Dow Jones Pharmaceutical Index, again, third-party index. Fees, 0.42% MER, management expense ratio. Trades on average about 8,600 shares a day. So it's not as liquid as the other two. In terms of the portfolio makeup, it has a very U.S. focus. It's basically U.S. companies, and it's got a pretty good distribution. It's almost a very similar. Let's do that properly. Even distribution. And then finally, in terms of tracking error, it's a little bit high. It came in at about 3.3%, and I was looking at it over a 10-year horizon. These are all very long-term rates of return that I'm looking at, time periods that I'm looking at in terms of when I'm looking at tracking error from that perspective. So it's a little bit high. So there you go. So that's kind of the tail of the tape of these three. So now the question is, which one of these would be, from my perspective, worthy of consideration for investing? So ultimately, when I want to buy any ETFs, I want to buy them passively managed. So from that perspective, the Spyders and the iShares are probably the ones that I want to go to. Low cost. The Spyder is the XPH product, comes in at, has a slightly lower cost. It's below 0.5%, which is great for a specialty type ETF or a sector oriented ETF. In terms of liquidity, the Van Eck has a pretty, and the Spyder again has a pretty good, a reasonable amount of liquidity. There's a reasonable amount of trading volume, so you're going to get a little bit more accurate price discovery from it. Benchmarking perspective, the Spyders following the S&P and the iShares following the Dow Jones, following a third-party index, to me is a much more effective and a much more takes out the possibility of kind of manipulation by the ETF vendor. So from that perspective, the Spyder and the iShares are a little bit more preferable for me. In terms of the portfolio makeup, it's not the Spyder has a fairly equally weighted distribution, so it's broadly diversified. It's not concentrated in just a handful of companies. It's spread out amongst a lot of companies, so there's more diversification. And from a risk perspective, that's obviously a good thing, because that's my goal. I want a basket of diversified pharmaceutical companies. So from that perspective, the Spyder and the iShares kind of does the trick there. And then finally, the last element I'm looking at in terms of tracking error. The Spyder, again, very low in terms of its tracking error, and the Van Eck is pretty solid also on that. So when I look at all these elements together, as we can see, it looks pretty clear that if there was one of the ETFs that if I was going to consider an ETF right now, it would probably be the Spyder. That seems to be the one. Passively managed, low cost, decent liquidity. As I said, passively managed, low cost, reasonable liquidity, tracking a third-party index, broad distribution in the portfolio, and it has a low tracking error, so it kind of earns whatever the benchmark rate of return is in the marketplace. It tracks closely alongside that. And when I put those elements together, this seems to be the winner for that. So that's my analysis of some pharmaceutical ETFs. If you're interested in learning more about how I go about figuring out, or learning about how I figure out what kind of ETFs to buy and how to make decisions regarding ETF, you can check out my website, sageinvestors.ca. I teach a course called How to Invest in ETFs, and if you're interested in taking it, it's an online course. If you're interested in taking it, you can check it out and register and kind of up your game in terms of having an understanding of how all these ETFs work. That's a bit. Thank you very much for listening. My name is Aman, Raina of Sage Investors. Cheers.